Wells Fargo, lots of numbers, but the earnings per share is $1.25 that the company posted. The estimate's $1.16. You can see the stock's reacting positively right out of the gate, up 3.5% or so. The revenue number was also above. $20.53 billion was what the revenue number was, and the street was at $20.118 billion. We do have a charge-off number here, $764 million, and also second quarter provision for credit losses, $1.71 billion. Net interest income, $13.16 billion. That seems like a lot. Non-interest income, $7.37 billion. Return on equity, 11.4%. I don't know what Stephanie Link is focusing on, but both of these stocks are up on this. She's chief investment strategist at Hightower and a CNBC contributor. 2 for 2 in terms of the stock reaction anyway. Positive on both. Steph?
Yeah, good morning. I think expectations were really pretty low for the entire group. I mean, JP Morgan has been the standout, up 11% year to date, versus the index down 16%. So it's held up well, but I think that was expected because they are gaining market share versus some of the smaller banks. But I think the valuations are very supportive, and I think there were puts and takes in both quarters so far. Nice to see beats. Expect, though, the provisions and non-charge-offs to actually be higher than expected, which we saw. So net, you step back. On the negative side, you have higher deposit betas and costs. You have non-interest-bearing deposit outflows. You had the loan growth, the H8 data coming in pretty weak, about 1-2%. For loan growth. But on the positive side, you have credit is pretty good. Provisions are expected to go higher. That's okay, though. And valuations very supportive, as I mentioned. I think the one area, Joe, in banks that I think is the most exciting for me anyway, is the capital markets piece, because you are starting to see green shoots in terms of the equity markets were up 8% in the second quarter. You have credit spreads are tighter, and you have underwriting and M&A starting to improve. So there are green shoots to be excited about. So I think the capital markets plays are a little bit more exciting, like Goldman Sachs, like Morgan Stanley.
So I'm going to stop starting questions with a so. Can't stand that. But Stephanie, the Silicon Valley, First Republic, the duration risk worries from those guys. They really were sort of alone in some of that, or does the whole industry not need to mark to market? There's got to still be some duration risk out there when the Fed goes up 500 basis points. But these right. banks, the majors, seem to be doing pretty well. They didn't have the same approach as the ones that got in trouble. And is that over? Is commercial real estate looming for some lenders?
I think commercial real estate, I worry about the smaller banks, Joe, the regional banks, because it's much bigger percentage of total revenues and of their books than some of the larger banks. And so that is certainly a worry and something to watch. But I think that it's the large banks that are taking share from the smaller banks, number one. Number two, yeah, they do have the commercial real estate risk as well, but it's, again, a small percentage. And also the non-interest-bearing deposit outflow, that is absolutely happening to everyone, but less so from the more diversified banks like a JP Morgan, like a Wells Fargo.